All right, everyone, welcome back to Lunch at the Market. Today, it's time to stop trading. Well, maybe not stop trading altogether, but certainly stop buying. It's clear that someone out there is a buyer because it takes quite a bit to get the stock, the S&P 500 index, all the way from the bottom of the range, was around 1,300, all the way back up to the top of the range, about 1,330, basically in one day. We've been in the range from 1,300 to 1,330 on the S&P 500 index for the last 20 trading sessions. We've bounced off 1,300 every time that we've approached it, all except one time. And the one time that we broke it, which was on February the 18th, we broke above 1,340 and then failed absolutely miserably. And by the time February 23rd was here, we were already back down to 1,300 just a couple days later. So what do all these levels mean? Well, it means that you should probably exercise some sort of caution in the market right now. Certainly don't know that you need to be running in there with everyone else to be a buyer of this market. Scale something back, right? Take something off the table completely, or just reduce your position size. If you've got 1,000 shares of something, cut it back to 800 or something like that. And if you've got 200 shares of something, consider taking it totally off the table and raising some kind of cash. Eventually, the pattern of between 1,300 and 1,330 is going to be resolved, hopefully to the upside. But when you have a day that's as green as today is, up almost 2%, the S&P 500 is up 1.5%, the Dow's up 1.5%, the Nasdaq's up almost 2%. On days like today, when everyone is a buyer, it usually makes sense to be fearful when others are greedy, and greedy when others are fearful. Today, everyone's being greedy, so we're taking the other side of the trade and taking some of the things off. Now, we are not saying to liquidate your entire portfolio and go into cash. That is not prudent investment management, and that's not today's lesson from the show, okay? When you stop trading, when you reduce your position size, that doesn't mean that you just exit the market. It means that you just reduce the size of your portfolio, your risk exposure, and up your cash position and be ready for opportunity when it strikes. Because if the last 20 days have taught us anything, it's, sell the highs and buy the dips. That pattern has worked for 2 years now, and so far, the trend is your friend. Don't fight the Fed, and don't fight the trend. All right. Now, we're not totally honest in saying that all we're doing today is selling. We did do some buying. Freeport McMoRan this morning was weak. It's back in the green, but it was in the red earlier today. So we're sellers of the 50-45 put spreads anytime Freeport McMoRan approaches that 50 level. It's held incredibly well so far, and we do think that there is quite a bit of support, and there's a lot of buyers waiting around that $50 level. Every time it gets down there, the buyers come in and they support the stock, and it trades back up. So we like selling those 50-45 calls, and we also added to our 50 strike January 2012 calls. They're just a little in the money. Usually we like to go more in the money, but we didn't want to put a tremendous amount of capital into this trade. We're reducing the cost basis of the long calls by selling the short puts against it. All right. Now, this morning we had James Altucher on our America's Favorite Trader show. Be looking for that episode next week. You can always download it for free on iTunes or listen right on the website for free at magnumopusfinancial.com. James pointed out a characteristic that he likes to use for valuation, which is enterprise value divided by EBITDA. And of course, you can go on Yahoo Finance and find both of these key statistics in order to come up with this measurement. For more on EV divided by EBITDA, you're going to have to turn into Season 2, Episode 2 of America's Favorite Traders, which will be out next week. Okay? But this value for Freeport McMoRan is 5.29, which is actually pretty right around ideal for what James Altucher talked to us about today on the show, which is why on the weakness in today's strong tape, we went in and added to our Freeport McMoRan FCX long position, or at least long biased position. Being short a put spread is the same thing, really, in terms of sentiment as being long. All right. We did some hedging today. We recently grabbed WFT, which of course is Weatherford, for 1965. Earlier this week, after we cleaned up our last caller, we went ahead and put in a caller again on the stock today. This time it's the August 2420. What's a caller? You have a long stock position, you sell a call against it and use the money to buy a put. This did actually cost some money, right? But we're still going to get about a 20% gain if we get called away in August at $24 a share. If we don't want to be called away, the great thing about being short options, as long as somebody doesn't exercise against us, which is what we did to whoever had sold us our collar before, as long as somebody doesn't exercise against us, like call the stock away early, then we can roll that out on the calendar and keep rolling out and up for additional gains in the stock. It just depends on what happens between here and the summer. Our goal is to protect as much of our positions as we can through the seasonal weakness that we usually see in the summertime, and then hopefully either buy those calls back during the summer, exercise the puts if we have to, but then resell calls against the stock as the stock rises higher after we get through the summer doldrums. Okay, but our goal is to make it through the summer safely. Now, the other thing that we did is MCHP. We sold out of our position there. It's been a terrific winner for us. It's gone up, not really in a straight line, but kind of what feels like a straight line over the past year. And the stock, pulling back on a 5-year chart, has had trouble 3 times around the $40 level. And you know what? We don't need to squeeze every penny or even every dollar out of a stock that we own. Once we get the gain that we're comfortable with, which is north of 20%, once we get that kind of gain out of a stock, we usually like to look for a good exit point on a day like today when the stock markets are just ripping higher. You know, it's a good day to say a bon voyage to some of our names that have been good to us. We've collected the dividend the whole time, so what started out as a round lot ended up with about a half a dozen shares for every 100 shares we were holding. So not a bad take for holding the stock for about a year, and it's been great to us. So we're going to wave goodbye to MCHP. It's nothing particular with the company other than the technicals. The stock has had trouble at the $40 level. It's approaching 38 right now, and we don't want to try to top tick it. So that's what we're doing today. Thanks for joining us again today. Have a terrific day. There's a good likelihood we won't be able to bring you a lunch at the market tomorrow. Some of us are going to be getting on a plane to head west for Utah and California to meet with some clients. And so most of the day is going to be spent in the air. So we'll try to get you an episode of Lunch at the Market if we're at an airport at a convenient time. Otherwise, have a good weekend. Be safe out there, and we'll see you Monday. Thanks for joining us again today on Lunch at the Market.